Well, as I mentioned there at the front, those Treasury yields continuing to shift higher. Let's take a look at the impact, particularly in the private credit market. Mark Sherwood joining us from iPartners now. Mark, good to catch up with you again. Thanks for joining us. So that's the story at the moment, isn't it? Where those Treasury yields are heading. What's your view on the impact that that's having?
Yeah, good afternoon, Andrew. Yeah, absolutely. Yields are higher right across the board, and that does correlate across to the private markets in terms of the private credit markets, particularly. So yeah, the yields are in favour of the holders of capital, i.e., the credit investors are in a pretty advantageous position here, because everything's just slowly shifting wider. Base rates out at 4 or 5% means, private credit yields that used to be 9 or 10% are now 11 or 12. It's that kind of dynamic that goes on in terms of the way that the world moves. So absolutely, we're in a pretty powerful position as private credit investors to negotiate slightly higher yields when everything is moving higher. So the borrowers of capital do wear that a little bit in a higher level of borrowing that they've got to pay in terms of the price of borrowing capital, essentially.
Yeah, there's certainly the mercy of the markets at the moment as far as those that are borrowing. But as you say, on the other side of the coin, it is advantageous. So what are you seeing as far as investor demand is concerned?
Investor demand is definitely increasing, particularly for private credit. Not only in Australia, but it's actually a global theme. And all sorts of recent research is pointing to that as well, particularly globally. I recently read a BlackRock insurance survey that they put out annually. And that said that 60% of their investors that they surveyed were going to add to private lending in the next year or so. So it's definitely a global theme. We're seeing more capital getting allocated towards private credit in people's kind of bond percentage. So when people run a portfolio where they target a certain percentage in fixed income type assets, they're definitely increasing the weightings towards private credit, making up a section of that fixed income weighting, essentially.
Where is it proving to be most attractive regionally, I guess? Where's Australia stack up, just as far as if you are investing in that space?
I think in Australia, the best risk reward that we tend to see tends to be in what we'd refer to as the asset-backed lending space. And that's particularly where we're funding some of the non-bank lending businesses, the businesses that provide alternative sources of capital, particularly to private companies as well as private borrowers, private individuals. I would say that's probably the sweet spot in terms of where we're seeing the strongest risk reward tilting in the favour of the investor, where we can essentially fund a growing and strong private business, but also take the security of the loan book when we make that funding to them. So that really gives us quite a strong level of security and support to the credit position that we're taking with that particular business. So that's a space that we've been very active.
So beyond real estate, where are you seeing opportunity at the moment?
Yeah, I'd say real estate as well as business lending
Right.
is where we're seeing the strongest opportunity. Definitely in real estate, there's a lot going on where property developers or property groups are just looking for kind of help to bridge finance to a certain point in a project. And some of these can be really interesting projects to fund because we can take a first mortgage exposure over the land. It might be a land subdivision type project where we know we're taking a first mortgage position at a fairly conservative gearing ratio. These types of deals can be very interesting to have a look at. But then also to your question, when we're funding some of those non-bank lenders that lend to private businesses but have got very strong track records in the way that they've made sure that they've kept their arrears really low and any potential defaults very, very sound and secure, even in an environment where the economy is just generally softening. So that's really what we're looking for.
What do you need to look out for, Mark, I guess, in terms of timing? We know that those, as we were talking about, those Treasury yields are heading higher, and we're seeing that globally at the moment. How far ahead do you need to look, and just in terms of your investment strategy?
We tend to like trades that are kind of anywhere from 12 months to 18 months, maybe a maximum of 2 years at this point in the cycle. That where an investor can lock in some really sound returns for kind of the next 2 years. Hopefully that gets us through this most volatile or most uncertain patch of economic history that we're kind of now sitting in, where there's so much uncertainty as to whether there's further rate rises or whether there's soft landing scenarios, perhaps particularly for our local economy. So that for us, that if you can get sound returns that pay you a strong and consistent yield for the next sort of 18 months to 2 years, they're the types of transactions that we're tending to favour.